Okie dokie. Whoop, that's not going to work. Let me fix this camera. One sec. Okay. All right. Welcome, gentlemen. How are you this week?
Pretty
Oh,
good.
Okay, we got it pretty good from San. Sean is hanging on for dear life, it sounds like.
yeah.
Hey, I wanted to follow up on your spreadsheet real quick. You're pretty much there. The one thing, though, when you buy a spread, it's not a credit spread anymore. When you buy a spread, it has to be a debit spread. That's kind of the definition. If you buy the option, if you buy the spread, it's a debit spread. If you sell the option or you sell the spread, it's a credit spread. So all you need to do is change the wording there and you've got it.
That's
Yeah.
Sean's spreadsheet, or what are we talking about?
Yeah, he had posted a spreadsheet in Slack and was looking for some feedback on it. So I was just letting you know that buying a credit spread is a misnomer. It can't be done.
I see what you're saying. It's fine.
Yeah, absolutely. All right, so let's dive in. First of all, do we have questions about the ways to set up either a credit spread or a debit spread, the differences between the two, when you might use them, that kind of thing so far?
Did I have the legs correct on it?
Let's take a look. Okay, let's see. Net credit, get paid. Leg one, sell to open, higher price. Leg two, buy to open, lower price. That looks good. Net debit, buy to open, higher price. That would be a call spread if the buy to close, lower price. Yeah, that looks good. And net credit, get paid. I'm assuming this is for a call credit spread then. Sell to open, lower, and then yeah, net debit. So this is a bear put spread. Buy put spread and bear to open. Yep, looks good to me. Yep, that's it, man. That is it. Okay, let me pull up our notes here. And we shall begin. So nobody's got any questions. Everybody's got this nailed.
I have a question, Robert.
Yes, please do.
Where's the market going? No, I'm just kidding. Just kidding.
Where's the market going?
Yeah.
Is a good
Where's the market going, and should I be short or long 100 contracts? No, just kidding. Just kidding. That is not a real question.
Okay, then I will not give you an answer.
Well, he was about to say something. Let him say it.
Okay, go ahead, Robert. Go ahead.
Hey, Robert, how are you?
I'm good. How are you doing?
Good,
Let's
good.
see. So, I mean, as I look
I have a question.
Okay.
So since I've been with like credit spreads, I've always struggled to get like 1/3 of the price. Like that's very difficult. Like even
What?
now with implied volatility being so high. So what's your? I guess that you said that we're gonna see that, but how do you look for like those good prices, like 167 for the $5 spread on a delta of
It comes
30?
down to it comes down to a couple of things. So first of all, you're usually in medium to large cap stocks. If you're trying to get a third of the width of the strikes on like a $10 stock, that's going to be almost impossible because it doesn't matter what the implied volatility is in a stock that cheap. The underlying price just will not support decent option pricing. All right, so that's the first thing, is check the price of the stocks you're looking at. The second thing is IV rank is really a big deal. So if I go and I look at Tastyworks right now, I'll just pull this up real quick. Let me share my screen here. All right. If I go and I look at a watch list here. This is just a basic watch list that comes by default in Tastyworks. It's called High Options Volume. I use it sometimes to scan for high volatility plays, simply because it shortcuts the liquidity for me a little bit. Okay, and so you'll find a variety of different things on here sometimes, but you can look at any watch list. What trading software do you use, Gustavo?
Thinkorswim.
Okay, so you can create a watch list in Thinkorswim, and then you're going to want to add a column that is called IV percentile. And it's actually a math glitch in TOS, but IV percentile in TOS is the same formula as IV rank in Tastyworks. So what you'll do is you'll look for anything in the IV rank, and on your screen it'll say, excuse me, IV percentile. Sorry.
I have that list, but I don't see the same results that you.
Okay, I'm just going to give you some examples here, okay? So if I go, let's just go right at the top of the list here at Pinterest. All right, everybody knows Pinterest. I don't believe Pinterest is going to zero. I believe they're in it for the long haul. I've actually seen, I'm in a mentorship course right now on leadership and business direction. And he spent an hour discussing the trends of the new year and the new decade, and don't be surprised if you know, more and more women get involved in leadership and money. And the point behind that is, without boring you with all the research that's going behind that, the point behind that is women love Pinterest, and they're going to be they already control more buying power than men. So just something to think about. So Pinterest is not going anywhere, in my opinion. Let's see what we got here. March. This thing really has gotten cheap, though. That's going to be tough. 25.20. Yeah, again, it might come down to stock price. You'd have to go a little closer to the money. This one, to your point, is not a good example because I have to go to the 41 delta there. Let's check Zoom. All right, this one's got an IV rank of 89.7, and it's been on the rise the last 5 days. Okay, so that's what this column is right here in Tastyworks, is the increase in volatility over the last 5 days, whatever that is. All right, Zoom's got a decent price and looks like some decent premium. So let's see, 20, 130, 125. So this is pretty close. This is the 29 delta. And I'm doing the 130, 125. I'm getting $1.60.
Yeah, 160.
It's close, not close enough. I don't have a problem going to the 33 delta, and I'm getting more than enough for that. So
Okay.
it really comes down to what you're looking for and when you're looking for it. All right. So you're going to want to make sure that the options are that the stock is not overly cheap. Usually it needs to be above probably $40. I'm just kind of guessing there based on my experience. 40 or 50 bucks is kind of the lowest. For example, pins is so cheap, I wouldn't personally trade a credit spread on it. So if you really want to trade Pinterest and you can't get the premium for a spread, I would just sell a put. I mean, for me with margin, that's 250 bucks in buying power to just straight up sell a put on Pinterest, and that's fine. Max loss on this thing is only about $2,500 because if it goes to zero, I'm paying $25 a share. But I don't think that's likely to happen personally, right? So selling puts comes with the same amount of risk. You still have the potential to take assignment, but as you'll see here today, as we go through the management rules, that's very, very, very unlikely if you trade the way I trade. All right, so I trade naked options, I trade naked calls, I trade naked puts, I trade credit spreads, I trade debit spreads, I trade strangles, I trade jade lizards, I trade straddles, all kinds of crazy stuff, some of which we're not even going to get into this class. I personally have not, since I started trading mechanically with good rules and following them. When I first got started, I was an epic moron. But after that time, I have personally never taken assignment when I didn't want to, number one. Number two, I have never had a margin call. So the mechanics work, but some people just don't like naked options. So if the stock is really cheap and you want to trade it and you're not getting premium for a spread, try a naked option. Now, as far as like a debit spread, that might be a different story. If I wanted to go long with a debit spread, which I wouldn't here, not with an IV rank of 90, but for the sake of argument, you'd have to see if you could get something that's cheap for positive theta. And this spread is okay. The pop's a little low, and we're right at half the width. So you could do that if you wanted to. If it were me, I'd probably just sell the put straight up on Pinterest. So anyway, that's the idea, all right? So you have a watch list of what you're looking for. And if you decide you want to go long or short, or you pick a stock, you pick a bias, whatever, the type of trade you're going to use is going to come down to the IV rank. But the price of the stock itself is also going to play a factor.
If the prices are too low,
Yeah.
you'll be getting a lot more than 30%, right? Is that something to avoid? Is that what you're saying?
No, what I'm saying is, let's just go back to the Pinterest example. All right. The IV rank on Pinterest right now is 90. So it should be a really good time to sell options in here. The problem is, because the stock is so cheap, you can't get 1/3 the width of the strikes for the credit spread. The premium's just not there. Now, if I go all the way up to the 40 delta with my short strike, I can get the premium, but that's too close. I don't like to go past, I mean, in the notes for you guys, I put 39 delta as like the line in the sand, but I'd have to really like the trade to want to even do that high. You know, I like to live in the 30 to 35 delta at the most, okay, if I can, which means if I wanted to trade Pinterest with puts, I wouldn't use a spread because I can't get enough premium for a spread, right? But because it is so cheap, I'll just trade the naked put outright. I'll get the premium I want, and the buy power on margins very, very, very small. But if Pinterest does somehow cataclysmically go to zero, I'm sorry, I got a text about a family situation. I think we're going to be okay. If the text does somehow go to zero, the text, listen to me, I'm all distracted now. If the stock does somehow go to zero, I'm only out $2,300 on this because of the, how cheap it is. So when the stocks get really, really cheap, like under 20 bucks, under 30 bucks, whatever it is, and the IV rank is high, I'll just sell naked puts, because even just owning the shares, this is pretty absorbable in just about any size account, unless you're literally trading with a $3,000 account, in which case you're going to have to use spreads and probably small ones. But that's what I was saying, is on cheaper stocks, if the IV rank is really high and you can't get the premium for credit spreads, I personally would just sell the naked put. Now, the RLT disclaimer that comes with that, of course, is
You're the one who pressed the button.
don't sell a put on anything you don't want to own the shares on. However, as I said at the start of the class, okay, I have never taken assignment when I didn't want to, when I follow my own rules. Okay. One quick little order of business. I was informed by our leadership that I have to start my classes with this disclaimer, just so you guys are aware, because I'm teaching options and naked options. So you all understand that you're pushing the buttons, not me. It's your money, not mine. I am not a licensed financial planner, and everything I'm going over here today is for entertainment and education purposes only. I am not here to tell you what to do with your money. So that is, now now we got that out of the way. Let me go back to what happened here. I closed my notes. Oh, I had the notes ready to go, guys, and then I shut them down. Give me 1 second here. Okay, here we go. All right, so any good questions, by the way. So Gustavo says, I see a different list of IV percentile. Yeah, so the reason for that, Gustavo, is because the list I'm actually using is a Tastyworks exclusive, okay? This is the watch list up here. It's literally called high options volume. All right. So you could use any watch list. The IV percentile, I sort it by that number. In Tastyworks, I actually use IV rank, but the list will change based on what the watch list is. All right, this isn't necessarily a high IV watch list. This is a watch list of high options volume tickers, which means they're very liquid. All right, so if you remember from the second or third class, when I'm looking to trade options this way, I want a lot of liquidity, so that I can make adjustments as needed when needed. All right, but there's a ton of watch lists in here. Like I could just pull up this Tasty default watch list. All right, I don't know what their parameters are for this watch list, but I can just, excuse me, I can just sort it by IV rank, and I can see recognizable tickers, right? I got Snapchat up here, we got Chipotle, we got, this is, oh yeah, Mexican ETF, we got Costco, we got Twitter. All of these have really high IV rank right now, and the IV rank has been on the rise in the last few days. So,
and in Thinkorswim, the IV percentile is the formula for where you're saying the IV ranking.
yeah, so this is one of the problems with Thinkorswim. I talked about this, I think, a little bit in the credit spread class, all right? There's really two main metrics to measure historical volatility against itself, right? You have the IV rank, which is a Tastyworks number. Tastyworks created that formula, and it's become more popular and more widely used to the point where you can find it on websites like barchart.com, as an example. And on my screen, that's this column right here, okay? But the older, more traditional number is what the options community had been using, which is called IV percentile. The problem is Thomas Wong, who is our resident Thinkorswim expert. So if you're in the community and you see Thomas Wong, he's kind of like our Thinkorswim guru guy. I'm more of the Tastyworks guy. He's the Thinkorswim guy. He actually broke this formula down and discovered that IV percentile, the formulas are different. All right, you can see that the numbers. I'm gonna mute this here for just a sec, Sean. Sorry. You can see that the numbers are different in Tastyworks, but in Thinkorswim only. It's just some kind of glitch around the way that they set their software up. The IV percentile formula is the same as an IV rank formula. So it's a little bit confusing, but yes, in Thinkorswim, if you want to evaluate options premium based on the mechanics that I gave you, where you're looking for IV rank at 30 or higher, ideally, that IV percentile number is what you're going to use. Yeah. Does that answer your question, Gustavo?
Yeah, no, I saw all the explanations in the previous videos, but
perfect.
I just wanted to.
Thanks for joining us, by the way.
Thanks.
Welcome. It's good to finally hear your voice and see you in the
likewise,
class.
thanks.
I'm glad we got that figured out. From here to the end of the class, it'll be Wednesdays, noon Eastern, unless there's a family emergency of some kind on my part, which does happen sometimes. I have teenage daughters, and some, and they have special needs, and it can get adventurous sometimes. So I apologize in advance if that happens, but normally we're pretty good. Okay, so let's before we move on, good stuff here. By the way, let's make sure everybody's clear one more again, about how to set up each different type of spread. All right, so we already looked at credit spreads. Let's go back to Zoom again, since that was the example we were looking at, right? So,
hey, Robert.
Yes.
Hey, let me jump back in, because I don't know if you finished or not. Were you about to give an outlook of the market or some thoughts on the market or something?
Oh, sure. Yeah, I could.
Yeah, you were in the middle of answering that question, and then
and then we got so rudely sidetracked. Yes, no, I'm kidding. All right, so for me, I teach another class in addition to this one that is all about hedging and market sentiment. All right, and this is one of the charts I use. I tend to watch the futures on a variety of different time frames, and I had been short on the futures, I want to say, when did let's see. So probably I had been short on the futures probably right around in here somewhere, I think is when I put my hedges on, and I rode them all the way down. And at this point, they have rallied to hit my trailing stop. So I pulled my hedges this morning. And if you look at the daily chart on SPY, we haven't made, here's the frustrating answer for you, Alonzo. Okay. We haven't made a decision yet. This retest gap is strong because we have a 2-day pennant pattern candle here, a 2-day pennant pattern candle pattern, and we gapped up out of it. If we can find a way to close above the 200 today, that's a really strong signal. The bottom might be in, this could be the bounce. But if we continue to chop around, and then here's some outcomes for you, okay? We either close above the 200 in another couple of days, kind of go up, retest it, and start to grind higher. We chop around and then grind higher, or this is just a longer term wave 4, which tends to be a little bit messier, in which we kind of continue to bleed off, eventually close below this level, and we go down even lower. Okay, those are one of the 3 outcomes. Which one's going to happen? I honestly don't know. Right now, I'm a little more bullish, personally. I've pulled my hedges, and I feel like we're going to get a little bit of a rally here. But that's just based on the fact that there's a massive pocket of liquidity in here, and we're basically just kind of riding that. If we get a strong close anywhere below this level, make sure you're buying puts or you're trading bearish or you're trailing winners tightly, that kind of thing. I think there's more reason to be bullish than bearish right now. All right, despite all of the negative press, despite all of the fear that's out there, when the Fed raises rates and it goes through what is the name for it? Falco puts it in Slack all the time. I forget. There's a specific term for what they're doing right now. When they trim their books and they raise rates, the market actually tends to have strong gains through that cycle because it's a sign of a flourishing economy. Okay, and so the stimulus work has been done, and I feel like there's reason to be optimistic at this point. So I think that a lot of the selling that happened was initial negative reaction to what the Fed was doing, but I don't feel like that's going to sustain itself for a long period of time. But I don't know that for sure, obviously, right? This is an indecision candle. You know, if we gap down tomorrow and come down here and then chop around and then eventually close below this level, we're going lower. But at this point, we've had a pretty good correction. So if you go from the top of the market down to the bottom of last, I guess that was Thursday, that would be 12%. That's a good, healthy, solid correction. You usually get one of those a year, unless you're going bear market, in which case you got to get down to 20%. And we haven't done that since COVID, obviously. A 20% correction would take us all the way down to about 380-ish. Well, 385-ish on the SPY. Whether or not we get there is going to depend on what happens with these 3 candles. These are hugely important candles. Look at the volume on these candles. All right, it's absolutely massive compared to anything that came before it. We haven't seen volume like that on SPY literally since the COVID crash. All right, so as long as that volume holds up, at worst we're going to go sideways to bullish. Until this volume gets taken out, I am neutral to bullish. But we get a close below there, it's curtains. Buy puts, sell your bullish positions, get short in the portfolios. All the things. Okay. That's my thoughts, Alonzo.
Thank you for sharing, Robert. I appreciate that.
Yeah, my pleasure. Okay. Let's get into let's get into the class now. All right, so today we're going to talk about how to manage these spreads. But again, just a quick review. All right, we've studied two different types of options spreads with that have a mathematical advantage of being successful, regardless of what the chart looks like, regardless of what the financials look like. Okay, so the first of all, we have the vertical credit spread. All right, so what do I mean by vertical credit spread? It means that both options are of the same type and they're in the same expiration. That's what a vertical spread is. Okay, in case that wasn't clear. So a put vertical credit spread means you're selling a spread of puts in the same expiration. So if this is, like I said, this is Zoom, IV rank of 89.1, 10% rise over the last 5 days. I don't know what Zoom's chart looks like. So again, there's different factors. The extent to which you want to use technical analysis is pretty much up to you. I teach the class to focus on the math-based metrics. Picking a stock and picking a direction is not as heavy a focus in this class, just because there's so many people at RLT that already teach that. We'll go over some things a little bit at the end of this course, guys. I will give you some scans and some tools I use, but I want to focus on the math-based stuff. Right now, I don't see a real good reason to be bullish on Zoom, so I'm probably waiting. But let's say you think you can catch the knife and you can and you can buy the dip. This is a good trade, statistically speaking. All right, we're at the 32 delta. We're getting paid $1.80 for a $5 wide spread. Remember, we're looking for at least 1/3 the width. All right, so 165 or better. Ugh, man, sorry about the chicken scratch. 165 or better if I'm $5 wide. If I'm $10 wide, I need to see 333 or better. I could do $10 wide. I probably would if I'm in a larger account, just because that allows me to do fewer spreads and take the same amount of risk, which obviously helps with things like commission and so forth. For the sake of adjustment, for the sake of commission, for the sake of capital efficiency, I mentioned this in the credit spread class. Always trade as wide a spread as you can and or are comfortable trading. All right. If you're in a $10,000 account, you're stuck at $5 wide because that's 3% of your net liquidity. But if you're in a $100,000 account, you could do 10, you could do 20, you could do multiples of 10 or $20 wide. The wider the better. Is 20 even an
Sorry,
option?
can you remind why is that? Sorry if you explained that already.
Sure. Here are the reasons why you want to go as wide as possible. Let me give let me put a little text box here. Okay. Number one, fewer spreads for the same amount of risk/reward equals cheaper commissions. Okay, that's the first reason. Number two, the Greeks, which is those fancy, the delta, the theta, the gamma, the rho, extrinsic value. The Greeks will treat a wider spread more like a naked option, which means it is easier to win and easier to adjust. Those are the two main reasons. Okay, if you can go wider based on your account size and based on the premium, that is always better, because the wider you go, the more it behaves mathematically like a naked option, and the more flexibility you have in terms of the adjustments you can make, the faster you'll potentially hit profit targets. All right, the Greeks are going to act on that spread much more intensely the wider it gets. All right. And and then of course, you know, obviously if you do two $10 wide spreads instead of 4 or $5 wide spreads, you're paying less in commission. That's just basic math. So these are the main reasons why I always like to do wider if I can. But you have to remember, you don't want to go over 3% of your account size. So if you're in a $10,000 account, a $10 wide spread is 6% of your account size. So that's probably not going to work. You should probably stick to $5 wide. So it will come down to your account size to some extent. It will also come down to the premium. Okay. So for example, the $5 wide spread on Zoom pays really well. The $10 wide spread on Zoom pays acceptably well. $335 for a $10 wide is fine. 1/3 would be $333. But if I go $20 wide, I need $6.66 to be a third of the width of the strikes. I'm not getting that here. So $20 wide wouldn't quite work for Zoom. So I would probably do the $10 wide if I were going to trade this spread. So there's no perfect answer, guys. Start off as wide as you can and then come in until you get a good spread that pays you the premium you need, is appropriate for your account size, et cetera, et cetera. You got to keep all of these factors in mind. Now, I believe in the notes.
Good, thanks.
Yeah, absolutely. I believe in the notes. Let me just double check while we're having this conversation. I did say wider is better, but I may not have been specific on that as to why. Let me just review this real quick.
Sorry, you also had another filter. I think it was an option, open interest. Is that being fulfilled in this case?
Yeah, you would definitely want to check the liquidity. Now, I pulled Zoom off of the high options volume list on Tastyworks, so I already know the liquidity is good. But as a mechanical process going through your checklist, anytime you want to trade a spread on a ticker, you want to check the liquidity. So the volume, we have plenty of options at the money. There's 1,000 on at least one line. There's actually several. All right, and the bid-ask spread is within 10%. So this is perfectly acceptable. Yep, good question. Okay, so that's credit spreads. And again, you can absolutely set this up to the bear side. Sometimes it's a little bit harder because puts just get more expensive. All right, but let's pretend that you wanted to short Zoom instead. Yeah, none of these are really paying anything. Despite the IV rank, the put skew has shaped it such that you'd have to go all the way to the 44 delta to get a reasonable call spread, which is just meh. I'd have to use, if I wanted to short Zoom, I'd have to use a bear put spread because the credit spread isn't working. So let's just go ahead and look at that since we're talking about that. So let's remember how we set up debit spreads. All right. With debit spreads, the key number we're looking for is the extrinsic value. All right, so I'm going to put my short strike right at the strike with the most extrinsic value, which is right here. And then we'll adjust from here, okay? So right now, I've got a lot of positive extrinsic value to work with. I might be able to get a cheaper spread. So let's back this off a little bit. Nope, that's the line. All right, so we are getting positive theta, but just barely. We got positive extrinsic value, pop's pretty good. Pop's really good, in fact. The market really expects Zoom to keep going down. That's funny. So this is a $10 wide spread. Remember, when you're paying for a debit spread, you want to pay about half the width of the strikes. So don't get that confused with credit spreads where you want to get paid 1/3 the width of the strikes. If you're buying a debit spread, you want to buy it for about half the width of the strikes. So make sure you keep those differences apart. Half the width would be $5. $5.35 is a touch expensive, but not unreasonably so. So this would be a potential option, but I just don't like the fact that the IV rank is so high, personally. Honestly, you know, if it were me, I'm a little bit more risk tolerant, I guess. I'd probably trade, if I really wanted to trade Zoom, I'd probably trade a strangle on this and skew it to the bearish side. But that's more advanced. We will get into that at the end of the class. Okay, so that's your review. Any questions on how to set up a debit spread versus a credit spread? All right, it's very important that you're very clear on the differences between the two and how to set them up, because you're going to manage them in different ways, as you will now see. No questions? Everybody's tracking?
Tracking.
Tracking. Okay, great.
Yeah, that's very helpful. Thanks.
Absolutely. Absolutely. Okay. All right, let's get into how to manage these things. All right. So step one, this should be review, because I had this on the notes for how to set up the spread correctly. All right. So with a credit spread, all right, let's go back to the credit spread example. If I sell this $5 wide spread in Zoom for $1.82, the next thing I'm going to do if I fill that trade is what?
Good to
Create an opposite
cancel
order.
order.
Take profit.
Create the good till cancel order. Yes. And what is my target? If I sell it at $1.82, what is my target for the good till cancel order?
You said 70% of
Nine-
profit.
91 cents.
Yeah, 90, 91.
Uh,
91.
it is 91 cents, and that's 50%.
Percent.
50%. Yeah. Yeah, there are guys in the community who do different numbers, and so sometimes that can get a little bit confusing. Me personally, the 50% number has been researched and back tested extensively by the Options Institute in Chicago and by the Tastyworks guys. So I like it. It works for me. So I will always do 50%. 50% of the credit received. So in this case, if we sold the $1.82 spread, as you already heard, that would be a target to buy this spread back at 91 cents. So that's another thing to keep in mind. All right, you're selling the spread, which means you're getting paid up front. How much of that money you get to keep determines your profit. You're hoping to keep at least half of it, which would be 91 cents in options terms, and that'd be 91 real dollars. So when you go to buy the spread back in order to close it, you're hoping you don't have to pay more than $91 to do it. Right? So that's how that works. Okay.
Hey, Robert.
Mm-hmm.
Question for you, and this may be in your document.
Mhm.
Do you ever trade SPX or any of the indices? I was just thinking that some of those numbers are off, but do you trade those or no?
Not usually.
Okay. No, just wondering.
You could. I don't know what the IV is in there. Personally, if I'm going to trade the indexes, I tend to do it in either SPY or Qs just for liquidity's sake.
Okay.
Because I don't know what the liquidity is like in here. I mean, it's good. It's fine. If we go to the 30 delta, let's say you want to short today's rally. You don't believe it. You think this is a rip to be shorted. You could come in here and do a $5 wide spread at the 30 delta, but you're just not getting any premium in here. Even with a 38.5 IV rank, you'd have to move up to get paid on this. Let's see. How far do we have to go? Yeah, you have to go all the way to like the 40 delta. That's going to be a pass. If I go to SPY, for example, 30 delta, 21 by 16. What's the IV rank in here? 57.5. Interesting.
I
Ivy
think
rank
there is
doesn't.
the same.
Yeah, the
Robert.
Ivy rank hasn't really caught up to what's actually happening to option premium, which does happen sometimes. All right, these numbers get updated daily, and the option prices react in real time. So if you look at the VIX, you can see that at the bottom of Thursday, we were nearly at 40, and we've dropped over 10 points since then. So across the entire market, option premium is going. So this isn't really a great time to sell any options while the VIX is crushing like this. So you'd have to kind of pick your spots, and the indexes aren't a good spot in this situation, in my opinion.
I think SPY and SPX are exactly the same. They are just 10 times more. SPX is 10 times of SPY.
Yeah, they both track the S&P 500. There's extra fees involved with
They
trading
are
it.
kind of down to the cents. I think it is 10 times.
The SPX is the cash index itself. So there are extra fees involved with trading that. So you want to be aware of that. The other thing with the SPX is the option cycles are a little bit different. They're actually talking about potentially making this a 24-hour instrument where you'll always be able to trade this, which would be kind of nutty because then I would be able to trade options all day, all night long. That's not something that's ever been possible before. Unless you're trading futures, which I am not because I'm in an entity, and trading futures in an entity requires like millions of dollars of exchange fees. It's kind of bonkers. But yes, essentially SPX is the same thing as SPY, just more heavily leveraged. This is the cash index itself, whereas SPY is an ETF. All right, so they're just different vehicles for trading the S&P 500. SPX has more fees involved because it is the cash index. That's really the main difference. Man, we are up 400 on the Qs. We're ripping. All right, anyway, so 50% of the credit received, that is which is also 50% of your max profit, okay? GTC order. That is the target for credit spreads.
Hey, I have a question, Robert.
Yes, go ahead.
We collected $1.65, right? So 50% will be like $1.65 divided by 2.
Yeah.
Would be 82 cents, right?
In which examples? Because in the Zoom trade, we were getting $1.90 or $1.80 something. It's actually come down quite a bit. We've had so you guys are watching option premium evaporate live. This was 10 cents higher not even 10 minutes ago. But it's still a decent premium. So this one's being sold for $1.73. When we did this just a few minutes ago, San, it was $1.80.
Oh, okay.
Or
All right.
82 or something like that.
So
$1.82.
that was 90 something.
91 cents.
91 cents. Okay.
Yeah. Yep. So once you sell the spread, you take that number, divide by 2. That's your target. Close the position with a GTC order and wait for it to fill. All right. That's step number 1. Now, the target for debit spreads is a little bit more involved. All right. So track with me here. Let's find something with some low IV that is more realistic for actually trading. Something where volatility has gotten crushed. IBM. That's funny. Let's trade. Let's see if we can trade IBM. Okay. What direction do you guys want to go on IBM? We're rising for now. I think I might be short-term bullish on this. It's going to chop around at some resistance a little bit, but a credit spread could work. That was the place to get in right there. All right, let's go bullish. All right, so we're going to do a bullish debit spread on IBM. So we're going to find the extrinsic value, put our short strike there. $5 is the smallest we can go. So what do you guys think of this trade? This is a $5 wide bull call debit spread. Based on what we've learned about how to set up debit spreads, what do you guys think?
It's paying enough, too expensive.
Yeah, that would be my first criticism, is that it's pretty pricey. I typically don't remember on debit spreads. I have like a 3/5 rule, right? So if I'm paying more than $3, if I'm paying $3 or more for a $5 wide, it's too pricey. The theta's there, extrinsic value is there, pop looks good, but this is a hard pass. So we need to see if we can get a little cheaper. Okay, this one's negative theta and negative extrinsic value. So the only way this would work is if we widen the spread a little bit. So this may or may not work depending on your account size. All right, something to keep in mind. But if we go to the $10 wide, this is better. All right. Pop isn't awesome, but it's not terrible either. We're getting positive extrinsic value, we're getting positive theta, and we're much closer to half the width of the strikes. All right, still a touch pricey, but not too bad. If I wanted to go bullish on IBM, this is what it would look like. All right, so let's just say we fill this trade, okay? We pay $5.40 for a $10 wide spread on IBM. Now, here's how the formula works. 35% of the max profit is what you're looking for, okay? Not the debit paid, all right? So a lot of people get confused on this. You need to make sure you are looking at the difference, all right? So let's just look at the Tastyworks trade window here for a second since they've done the math for us, all right? What is the maximum profit on this trade?
$4.65.
Yeah, if we fill it at 535, the prices again are moving. So, you know, it's a dynamic process. But yes, if we fill it at 535, or, you know, it's going to be the inverse of what you pay, because as I said, what's interesting about vertical spreads is they can only ever be worth their own width at the most. A $10 wide spread can never be worth more than $10. You can never sell it for $10, or you can never sell it for more than $10. You can never buy it for more than $10 unless you leg in, which why would you ever do that? But if you try to ship the vertical order for more than the spread is wide, most brokers won't even let you send that order. Like if I were to put a price in here for $12, they probably wouldn't even let me send it. Okay, I've actually had orders like that get rejected before when I've tried to sell spreads that were worth next to nothing. But anyway, so because of the fact that a $10 wide spread can only ever be worth $10, it's defined risk, right? So if we're paying $5.40 out of 10, then the other side of it, the 10 minus 540 equals 460. That is the most we can make. So that is our max profit. Everybody clear on the max profit number and how we got there?
Yes.
Okay. This is the number that you want to use to get your 35%. All right. And why? Well, mainly just because that's been researched to be a good number. All right. It's like Jeremy's 2.4R target when day trading. You got to have a target somewhere. So pick one. But 35% has been researched and back tested by the entities that I named earlier. MIT geniuses far smarter than me, as a optimal target for making good risk reward while also maintaining a higher win rate. Okay. So if we take this $4.60 here as our max profit, now we have to multiply that by 0.35 because that's the 35%, right? Okay, so let's pull up the old calculator here. 4.60 times 0.35 equals $1.61. That is your targeted profit amount. But if you pay, but it doesn't stop there, okay? If you pay $5.40 for a debit spread, and then you sell it back at $1.61, what happened?
You
Anybody?
lost money.
You lost money, exactly. You don't want to do that. That's not the order number, right? You have to add that to the debit you paid. This is your profit number. You want to make $1.61 on the trade, but you still have to add that to the debit that you did end up paying. So 540, depending on what you get filled at. I mean, again, the prices are moving around. 540 plus $1.60, I'll just do $1.60 to keep the numbers even, equals $7. This is what you're going to try to close your spread for. That's your GTC order target. All right. Now, I have put every step of that in the notes for you, but I will use the example that goes along with the video we just did. Okay. All right, so example, $10 minus 540 is what we were gonna pay, equals 460. Okay, multiply the max profit, which we said was 460, by 0.35 to get a target of $1.60. It was $1.61 technically. Wait a minute. Multiply the max profit.
$1.60 is what you want.
Yeah.
That's all.
460, and this is, whoops. This is what we want to do. $1.61, I think, was the actual number. Because I want this to be clear if you guys go back and you follow along step by step. I want it to match what this sheet says with the video, okay? All right, finally, add the target amount, which is $1.61, to the debit you paid, which again was $5.40. And the GTC order to close the spread would be $7.01. Credit. All right. This step by step should match everything we just said. So once again, the simple way to think about it is 35% of the max profit. Okay? That is the target. That's it. How you get there is the step by step. All right, so the max profit's $4.60. 35% of that's $1.61. I guess I should be more specific. 35% of your max profit, just so there's no confusion, plus the debit you paid. Okay? We have a question. Okay, no problem, Sam. We usually go about an hour and a half, just so you know, but I understand you're on a lunch break, so no worries. Okay, so anyway, that is the formula for getting to your target on a debit spread. A little bit wonky, but once you get used to it, it actually goes pretty quickly. Now, here's what's cool. If you use Tastyworks, they'll actually do this for you. When you right click to close a position, you can set a percentage target and they'll do all the math for you. I don't have any debit spreads right now, or I'd show you how that works. Okay, so those are the targets, team. All right, use a GTC order. That's how it works when everything is going according to plan, right? This is when the getting's good and the good times are rolling. What happens when it's not working? When it's not going so well? You're wrong and you got to defend your spread somehow. Now what? All right, well, let's talk about it. All right, couple of outcomes here. Step one, for both spreads, if the GTC order does not fill, but you are profitable at 21 days to expiration, close the spread for a small win and move on. All right, It doesn't matter if you have a credit spread or a debit spread. If you get to 21 days to expiration, you're out if you're up. Sometimes a trade doesn't quite work the way you want it to, and it's time to just move on and redeploy capital. All right. If you watch the day trading moderators, they do this kind of thing all the time. All right. They have a target, but if the trade kind of meanders around and doesn't really go anywhere for like an hour, hour and a half, they'll just lower that target and raise their stop until they're eventually out of the trade, because it's not quite working. So why take a loss, take a small win, move on with your life? Same kind of concept. All right. This is one of the very, very important key ways that I don't get assigned and don't get margin called. Because no matter what, I'm gone by 21 days to expiration. So one of the reasons for this, so what does that mean? Robert, you never hold your options to expiration? What about all that juicy theta? What about it? Let's talk about it. Most people don't understand all of the Greeks and how they work together, okay? We're going to call this price, and we're going to call this time. All right, so a standard theta curve looks something like this. The price of the option does, you know, something like this. And then we're going to say this is expiration over here, okay? That's the expiration. Okay? Now, a lot of people love to hold their options all the way to here because they want to capitalize on all this juicy, hold on, all this juicy theta that came here. I get it. But here's what they don't realize is happening at the same time. There's another metric. We're going to call this gamma, another Greek. And the gamma is doing this. All right. What is gamma? Gamma is the rate. You don't necessarily have to know this. You just need to be aware of it. Okay. Gamma is the rate of change in delta. What is delta? It is the mathematical representation of your directional risk. So if your directional risk is changing, that's important. You should know about that, right? Like, okay, I'm either taking on more risk or less risk as the delta changes. Well, gamma is the rate of change in delta, and gamma goes up exponentially as we approach expiration, which means your delta as you come into expiration is changing very, very rapidly. How many of you have had the experience, which by the way also means that your risk is changing very, very rapidly? How many of you have had the experience trading credit spreads or trading puts where you're winning on a trade, you hold it into the last week or two, something happens and it goes into a catastrophic loss almost in a single day? Has anybody had that experience?
Yep, count me in for that one.
Yeah.
Oh, sorry.
That you're good. Yeah, I mean this is why, okay? Because the gamma ramps up heavily as we get to expiration. And here's the thing, guys. If you trade the first half of the option cycle, take your profits and go find another trade the first half of that option cycle, take your profits, go find another trade, and you just cycle your trades, you're not really gonna make any less money. So there really is no good reason to trade the back end of the option cycle. You're taking on an insane amount of gamma risk, and the premium is just not worth it. This is why people win on 7, 8, maybe 9 out of 10 credit spreads, but that 10th one blows away all the winnings because they just held it too long and it became an ugly loser overnight or within a couple of days. Okay, so this is why we do not trade in the last 21 days of an options contract's expiration cycle. Me personally, I know guys that do. That's a different style of trading. If you want to trade in a math-based way, if you want to trade in a statistically advantageous way, you're out at 21 days, which is probably right about here on the curve. Right before that theta risk, or that gamma risk, excuse me, starts to become not worth it. Okay, so that's why. That's why we do this, or I do this. Is most of the time after 21 days, what little premium is left is not worth the potential risk of the entire position going against you. All right, so let's talk about what happens if you're down. By the way, I did put this note in here based on a question I had in a prior class. There is no statistical advantage to legging out of a credit spread. Okay? Once you start legging out of a credit spread, you have abandoned math-based technique, and you are now 100% trading the chart. And you're hoping that you can perfectly time the market as far as when you're going to close the long put and when you're going to close the short put. Some people are able to do that. My experience is most people are not. So when I close these spreads and I get out of these spreads, I don't leg in or out of them because, again, there's no statistical advantage to it. What goes on as a spread comes off as a spread, gets defended as a spread, gets, rolled as a spread, whatever. I don't leg in and out of things, me personally. Any questions on that? I'm not saying you don't, I'm not saying you can't. And I know guys that do. It's just a different style of trading. You have to understand, once you start legging in and out of spreads, you are 100% relying on your technical analysis at that point. All right. If you want to trust the math and you want to trust the probabilities, don't leg in or out. It just overcomplicates it, and there actually isn't a good reason to do it. Okay, San, have a good week. We'll see you on the flip side. All right, so let's move on. Now let's start talking about the less fun scenarios. What time is it? Oh, we got plenty of time. Yeah, we got about 25 minutes here, I think, to go through this. All right. I'm going to do the debit spreads first because the credit spreads are kind of their own thing. All right, so what happens? You hit 21 days to expiration. You put the spread on, but you are losing. You're down on the trade. That's going to happen probably 20, 30% of the time. Now what? Now what do you do? Anybody who sold a credit spread in like the last week or two is down right now. Unless, well, I mean, maybe not right now. The market is just ripping right now. Maybe they recovered, but before today, they were down. Anyway, what happens now? All right, let's talk about debit spreads first because it's easy. I still close the trade unless I'm near max loss, and then I'll wait another week or so. But there is no ability to manipulate the debit spreads, okay? So that's one disadvantage to trading debit spreads, which is why, and I believe I said this in the one of the prior two videos. If not, here it is again. If I can trade a credit spread, I would always prefer to do that because a credit spread has a better chance of winning because it has more options for defense. So let's just review the life cycle of a debit spread, okay? You put the trade on. You set your GTC order. If I were to do a little flow chart here, can I do that? Or is that going to be too sloppy? All right, so we fill the trade. Okay. We go out, with the GTC order. If it fills, you're done. What if it doesn't fill and you get to 21 days? This is not going to work. I need one of those like flowchart creating softwares where I can just like throw stuff in there. Anyway, if you get to 21 days and you're up, you close the spread. But if it's a debit spread and you get to 21 days and you're down, you still close the spread. Because as I mentioned to you guys, there really isn't much, there isn't a whole lot it seems tempting to want to hold on to the bitter end, but statistically, it's just not, it's not to your advantage. So this is how I avoid taking max loss in most situations. But once you put a debit spread on, it's going to be a win or lose deal. All right. That's why setting it up correctly is so important. All right. You need positive theta. You need positive extrinsic value, because if you are a little bit wrong or it takes a little bit of time for you to be right, you need that cushion. All right. So it's still a statistically advantageous trade, but the win rate on debit spreads is markedly lower than credit spreads. It's still better than buying the stock outright. All right. I think debit spread win rates can be 50, 60, 70%, depending on how good your charting is. Just on the math-based side. All right. But on a credit spread side, you know, you combine all of the factors, you play good defense, you could potentially get that win rate as high as 70, 80, 90%. All right. So this is why a lot of people don't like debit spreads or trade debit spreads. But if you set them up correctly and you do it in a low IV environment where you might be primed for an IV expansion, debit spreads can work just fine. I trade debit spreads probably 30 or 40% of the time. But once you get to 21 days, if your GTC order hasn't filled, the debit spread is done no matter what. So that's your stop, basically. And you're either trailing a winner or you're out for a small loss at that point. Okay. All right. So let's get into the credit spread now, because this is where it starts to get a little bit fun. I'm going to walk through this and then we're going to do some math here. Okay. If you are down on the trade at 21 days, or your short strike is getting tested, that's a little bit of a bonus condition of the credit spread. Okay, so let's talk about what that means. Let's go back to Zoom, because that was the credit spread example we've been using today. If we fill this trade for $1.80, oh, I wonder if we could back up a bit. Not quite. If we fill this trade for $1.80, all right, where is my short strike? Somebody tell me. Sean, where's my short strike?
1080.
That is the bid of the short strike, yes. But what strike is it?
135.
Correct. Yep, you got it, man. Perfect. That is the short strike of the credit spread. All right. So if we get to 21 days, excuse me, if we get to 21 days to expiration and I'm down on this trade, or Zoom comes down to 135 and touches that short strike number, if either one of those happens while my spread is on, I'm going to do something. Okay? What am I going to do?
What are you going to do?
You have a couple of options, all right? First of all, you can straight up close the trade for a loss. All right, so they have done studies on this through back tests and back trades, massive simulations. If you put spreads on and you set your GTC orders and let your winners just get filled, and then every other spread that doesn't fill a GTC order, you just close it at 21 days no matter what. If that is all you do, you can still be profitable trading this way. So that is the very simple, very straightforward, very easy, no nonsense, oh, no worries, buddy, way to do this. All right. You put the spread on, you set your GTC order, and then you set a timer on your calendar or on your chart or wherever. And at 21 days, you take the spread off, unless the GTC order fills, in which case then you win anyway. That's the easiest way to do it. Okay? That's what this number 3 says here, which actually I think I'm going to switch this. Let's cut this and paste it here. So if you're not comfortable rolling, you can simply close at 21 days and still be profitable over time, statistically speaking. Okay? So that's okay. Some people, they get into arguments with me about how rolling options is evil or confusing or whatever. I get it. That's fine. You don't have to do it. However, you should be aware of the advantages of rolling the option. All right, so that's what we're going to talk about now with our last 20 minutes. Your other choice is to roll the spread forward in time for a credit and wait another month. If you can also adjust the strikes to be further away from the money while still getting a credit, go for it. All right. Let's show you exactly how this works. Let's say, for the sake of arguments, that we fill this $1.75 $5 wide spread on Zoom. All right. I'm going to blank that out so I can just get some space to work with here. Let me just get like a big blank page here that isn't blinding. All right, here's how this works. All right. $5 wide spread. I want to start showing you guys the magic of how this math works. Okay. We fill the trade at $1.75. This is what's known as our cost basis. Our cost basis on the trade is $1.75. All right, we put the trade on. What is our target GTC order? What is our target GTC order if we fill the trade at $1.75 on a credit spread? Who can tell me?
$1.75 times 1/2 plus $5.
Is that right? I've never done it that way. Times 0.5 plus 5. No, that's not going to get you where you want to go. Don't confuse this with the debit spread formula.
Oh, okay.
The easiest way to do it is just to divide the credit by 2, because you're looking for 50% of the credit when you're doing a credit spread.
Right. I mixed it up with the debit spread.
Yeah, no worries. Yeah, we're talking about credit spread. Remember, debit spreads are just dead at 21 days. There's nothing you can do about those. Everything from here on out is strictly credit spreads. All right. Okay. Our target is going to be 88 cents. All right. That's what our target's going to be. Okay, that's good to know. What is the maximum loss I will take on this trade if the spread closes fully in the money, worth $5? Anybody know?
$5 minus 88 cents.
We sold the spread for $1.75, so it would actually be $5 minus $1.75.
Oh,
Mm-hmm. Which is $4.25. No, $3.25. Sorry.
okay.
So this is what the trade looks like when we fill it. All right, $5 wide spread. Let me change the color here just so it stands out a little bit more. Okay. $5 wide spread. Cost basis, we sold it for $1.75, which means we got an 88-cent target, which is $1.75 divided by 2. And our max loss is $3.25 because $1.75 plus $3.25 equals $5. So that is the worst case scenario. We would lose $3.25. All right, we get to 21 days. Our GTC order did not fill. We're down on the trade. So we make the decision to roll the spread into the following month, roll it forward to the next monthly cycle at 21 days. All right, this is a decision you have to make at 21 days to expiration. If you cannot get a credit to roll your spread, you're done. You do not want to roll for a debit ever because you are actually paying money in that scenario, which means you are adding money to a losing trade, which is never a good strategy in any kind of trading. But if you are able to get a credit to roll the spread forward in time, there are a number of advantages to doing that. All right, so let me show you how that works. Let's say for the sake of argument that they're offering you a 10-cent credit to roll the spread. All right, so you roll the spread forward in time and you get paid 10 cents to do that. This is where you kind of have to stretch your brains a little bit. And I tend to think about options trading and options spread trading as trading a position. All right, and this is where people kind of get warped out of shape a little bit. If I close this spread and I sell a new one in the following month, is that a new trade? Some would say yes. I don't agree. Because if I roll the trade, which is to roll the trade technically means you close one spread and you open a new one, I'm simply adjusting my position. All right, so, and we do this all the time. If you guys have ever pyramid traded or position traded any kind of large position, this is commonplace. If you buy 100 shares and sell a covered call, and then you close that call and sell another one, you rolled that call. Okay, that's position trading. If you buy a bunch of shares, if you pyramid in over like 3 or 4 orders, and then you sell a caller, and then you close that caller, and then you sell a covered call, and then you close that call, and then the stock comes down and you buy puts for protection, and then the stock goes back up and you close those puts for a profit. Like, but you only ever had those same 100 shares. Is your P&L going to show every single one of those trades all at once in that same P&L? Yes or no?
No.
No, it's not. Right? So you're trading a position and you're adding and subtracting option legs around a position. I think of option trading the same way. All right. So if I close the spread I have and I sell a new one in the next month and I get paid a credit to do that. In other words, let's say I close the trade for $2 and I sell the next month spread for $2.10. The difference is a 10-cent credit. I got paid 10 more cents. I have a $5 wide spread, and my cost basis on it is now $1.85. So even though it was in January and now it's in February, if I rolled it forward, because I got paid a 10-cent credit to roll, my position is basically such that I sold a $5 wide spread now for $1.85 instead of $1.75, right? Now, why is that a good thing? $1.85 is my new cost basis, which means I'm going to set a new target, right? $1.85 divided by 2 equals 93 cents. So now I'm actually going to make more money on the trade. because now I have a 93-cent target instead of an 88-cent target. Additionally, there's even more benefit, but wait, there's more. Remember, we're talking about a $5 wide spread that can never be worth more than $5. So if I sold it for a cumulative cost basis of $1.85, what is my maximum loss now on this trade? It's not 325 anymore. What is it?
235.
No. It's actually 315. It went down
Because you gained 10 cents.
because I got 10 more cents. $5 minus $1.85 is $3.15. So by rolling the spread forward in time, I give myself an additional 30 days for the probabilities and the statistics to play out in my favor. I improve my cost basis. I get a better target to make more money, and I reduce my risk because I'm able, the maximum loss I can take on this trade has actually gone down. When you add up all these advantages, for me personally, rolling a credit spread for a credit is a no-brainer. I will do it 10 times out of 10. I don't care what the chart looks like. If I can roll a credit spread forward in time for a credit, it's going to happen because there's way too many good things that happen when I do that.
Mm. Yeah.
Questions on how all this math works? Gustavo, you still awake over there? You with us? Uh-oh.
Yeah, I'm here.
All right, perfect. Glad to hear it, buddy. Alonzo, you
No,
tracking?
yeah, I'm just thinking about commissions because rolling a trade is very expensive.
It depends on your broker. So Tastyworks
Of course,
does
yeah,
not,
of course.
Tastyworks does not charge you to close because they want you to be able to roll. All right. So on Tastyworks, for example, I pay $1 per leg to open. So that means per trade I get paid about, or I have to pay about, if it's a spread, if it's a 2-leg spread, I have to pay $2 in commission. But there's no closing fee. So that's the most I pay. And then when I open up the new trade, that would be like another $2. But when I close it, that will also be free. So when I'm rolling, I want to make sure that it's a valid concern. All right. So that, if you're getting a 1-cent credit to roll, that's not worth it because you're going to lose that in commission. I agree. But on Tastyworks, as long as you're getting 3 cents or more, it's worth it by even $1 because you could eventually make money on a trade rather than closing the loser. So you do have to understand your commission. You do have to understand how that works. On Tastyworks, your margin for error there on commissions is about $2. But again, I don't know what you're trading on. So everybody's a little bit different. Oh, we got a chat here.
Yeah, I'm on Thinkorswim.
Yeah, Thinkorswim is a little bit more expensive. They will not charge you to close. Let me see. How did this work? There's some special parameters there. Their pricing's a little bit deceiving. They try to make it look like they don't charge you to close, but they actually do charge you to close in most cases. I'd have to look it back up. So with Thinkorswim, you'd probably need about at least a 5-cent credit to make it worth it, I would think. So definitely something to be aware of. Yeah.
Yeah, no, I'm at this moment I'm facing like 3 credit spreads that I have to see if I just close them for a loss or
What's the expiration
them.
on those?
23 days.
Okay, yeah. So you're coming up on decision time for those.
Yeah, I guess we're all.
Yeah, yeah. I mean, I'm in the February monthlies right now. So Friday is
February.
21 days for me. So I'll be rolling all my positions. I'll be adjusting my beta weighted delta. I'll be adjusting my portfolio hedges if I'd want to see if what kind of delta I want to carry into the weekend. And then we're off
I
and
want to see
rolling.
that. That's what I'm really interested in, all the portfolio management and trying to stay within the neutral. That's
Well,
coming on
that's
next class, or
yeah, that's a different class, Gustavo. That's my hedging class. This is more of a trading class. If I have time at the end of the class, we'll try to squeeze some of that in. Okay. It's going to depend on how the last week goes. But the last week is an open week. It's a little bit flexible. So sometimes I try to add in little bonuses depending on what the class wants to see. If we have time to do some portfolio management stuff, we will. Okay.
yeah, that would be great.
Sure. Yeah. All right. So let's do one more example. A month goes by. We got a few minutes. A month goes by and we're still down. So we got to roll again. Let's say this time we get only a 5-cent credit. A 5-cent credit improves my cost basis to $1.90. All right, which would be a new target of 95 cents, and it would reduce the maximum loss to $3.10. Because again, we're still working with a $5 wide spread. So the math inside of the defined risk spreads never changes. I've had situations where I've rolled a credit spread 3 times until I got backed up against earnings. All right, so this is how the math works on rolling. And to the point I was trying to make there, I rarely hold any spreads over earnings. Only if I'm already at max loss would I do so. And you do need to be potentially willing to take assignment of the shares. I put that in there just for CYA, guys. Okay. If there's an outlier move and there's a massive gap down, there's always a chance that someone's going to close a deep in the money put. But before 21 days, I personally have not experienced that. So that's up to you. But I don't usually hold over earnings. So if I'm still down, but it's not 21 days, but I have earnings the next day, I'm probably out. I'd rather take a small loss than have a big gap down and get crushed for a huge loss. Does that make sense? I don't hold spreads over earnings unless I'm already at max loss. So there's been a massive move. The spread is toast. It can't get any worse. So why not hold over earnings at that point? Because if you get a big gap up, you can get out for a small loss at that point. That's kind of my thinking. Okay, that is what I got for you today, team. Questions, comments, concerns, snide remarks?
I gotta review this stuff to be able to do it.
Okay, yeah, watch the video as many times as you need. Send me questions in Slack. I'm available. I may not always instantly respond just because I might be in a rehearsal or another coaching session, whatever. But I will get there eventually.
Eventually.
Yeah. All right. So I'll get this recording posted. Oh, probably by the end of the day. I have some rehearsals this afternoon, so that's going to take up a little bit of time. But
What
we'll
are you
get there.
rehearsing? What are you working on? Are you in theatrics or something?
I'm a musician. Yeah, I
Uh,
play brass instruments. So I am in a jazz ensemble and also in a symphonic band.
Oh, cool.
Yeah, I volunteer at my alma mater just because the conductor sometimes needs help filling out his instrumentation. It's a smaller Christian school, so they don't always get all the musicians they need. So sometimes he'll reach out to alumni who can play still and ask them to come in and play with the bands. And I've been playing every year since I graduated, so I'm kind of a staple. It's just volunteer, you know. I don't get paid for that or anything. It's just something I do for fun and stress relief, and it's yeah, there's a lot of benefits to playing an instrument, but so
Absolutely.
okay. All right, so yeah, I'll post the recording as soon as I can. The notes that I typed up or that were on the screen today, I will also post those in there. Remember, for those of you watching, Rich, by the way, if you are watching this, which I hope you are, record a video on your phone saying, "Hi, I'm Rich. This is my trading journey. Nice to meet you guys. We'd love to see your face." Post that in Slack if you can. All right. But save these videos to a playlist so you can find them easily later. Okay. And then the notes I put out with them, you can just put them on a folder in your computer, or you can print them off, or whatever you want to do. All right. So I will see you guys next week. Watch the video as many times as you need. Next week, we're going to go in a completely new direction. We're going to learn an entirely new strategy now. Okay. We're going to get away from vertical spreads, and we're going to get into the land of diagonal spreads, where we're going to start working with option legs in multiple expiration cycles. And we're going to start applying some of the stuff we learned, add some new stuff, and create some really interesting advanced option strategies.
Wow. Okay.
All right. Take it easy, guys. See you later.
Thanks.
See you later.